In this session 28 of a 36-session corporate finance class, I'd like to complete our discussion of dividend policy by looking at dysfunctional dividend policies, companies that pay out too little in dividends and what the consequences might be, and companies that sometimes pay out too much in dividends and what the consequences there might be as well. In this, the final session, looking at dividend policy, I'd like to close the books on dividends. Reviewing what we've done so far, we've looked at how to look at a company and examine whether the company is paying out too much, too little, or just about the right amount in dividends, and when companies will come under pressure to return more cash to their stockholders. One word that I use to describe dividend policy is inertia, that most companies, in terms of dividends, do exactly what they did the prior year. Here's the other word that comes to mind when you think about dividend policy. There's a lot of Me Tooism in dividend policy. What I mean by that is many companies, if you look at how they set dividends, look at everybody else in the sector and base what they will pay in dividends on what everybody else is doing. That's very similar to what we talked about in the context of financing policy, where we said many companies set a financing mix looking at everybody else in the sector. So what I'd like to start with is how this works in the context of dividend policy. And to make the comparison, here's the first step. I took each of my companies and I looked at what they paid out in dividends, both as a yield and as a payout ratio, and compared it to the rest of the sector. And you can see my definitions of each sector. For Disney, for instance, I used US entertainment companies as my sector. I looked at the yield and payout ratio, and basically looking at the yield and the payout ratio for the sector, you can make a comparison of whether your company pays too much or too little relative to the sector. We've already noted with capital structure, financing mix, the limitations of doing this. An average number across a sector reflects an average across some very different companies, some smaller than Disney, some larger, some riskier, some safer, some lower growth, some higher growth. And we're throwing away a lot of information by just comparing to the average. So here's what I'd like to do. I'm going to again borrow on something we did in the context of looking across companies when it comes to financing mix and look at the entire sector. So this is the entertainment sector that I'm comparing Disney to. And as you go down the list, you can see that are the companies with very big differences from Disney. In fact, the only company on this list that is close to Disney in terms of being a diversified entertainment company is probably Time Warner. You have some really small companies, some high growth companies, some companies that really are not directly comparable to Disney in terms of its standing in the market right now. Obviously, the dividend yields and payout ratios vary wildly across these companies, and when I report an average, I'm averaging out across very different companies. I'll tell you when it's different. If you take a sector and you look across the sector and everybody in the sector seems to be doing roughly the same thing, then just looking at the average is okay. But in a sector like this where there are huge differences across the sector, it's extremely dangerous to look at averages across sectors. In fact, you could argue that Disney should not even be setting its dividend policy by looking at the rest of this sector. So what should you do instead? Here again, I'm going to do what I did when I talked about financing mix. Why should I stay focused on the sector? After all, there's the rest of the market out there, thousands of stocks. Why not look at all of them? So here's what I do at the start of every year again. I run a regression of dividend yield and dividend payout against variables that I think should drive the dividend policy of a company. And in particular, there are three variables that I'm going to use in these regressions to try to explain differences in dividend yield and differences in dividend payout across companies. First, I'm going to look at earnings growth. My hypothesis here is the higher the growth of the company, the lower the dividend should be, the lower the payout should be. The second, I'm going to look at the beta of the stock. Here again, my hypothesis is the riskier the stock, the lower the dividend should be. The safer the stock, the more it should afford to pay out. And the third variable I'm going to use is how much the company is borrowed. That's a dividend to capitalization ratio. Again, I'm trying to get a sense of do companies that borrow more money pay out more in dividends, and should companies that borrow less money pay out less in dividends. Again, I ran this regression across all companies in the market. Again, don't get too stuck on these variables. You might find that other variables work better. This is, after all, a pragmatic exercise. And I look at the R-squared, and the R-squareds are not great. They're about 20% for the dividend payout regression and about 26% for the dividend yield regression. Does that bother me? Not in the least. After all, if you want to compare to the sector, this is the reality you got to face. There are big differences across companies in how they set dividend payout and dividend yield. So this is called a cross-sectional regression because I'm regressing across companies and trying to explain differences in dividend yield and dividend payout. You're saying, how does this help me decide whether Disney is paying out the right amount? I went and collected the data for Disney on these three variables. I used the beta that I estimated for Disney of 1.00. I used an expected growth rate of 14.73%. Those were analyst estimates of expected growth in earnings for Disney for the next 5 years. And I used the current debt ratio for Disney of 11.58%. I plugged those numbers into my two regressions, and I got a predicted dividend payout ratio of about 27% and a predicted dividend yield of 1.40%. You think, what does that mean? Given how the rest of the companies in the market are setting dividend yield and dividend payout ratios, those are the yields and payout ratios that I expect to see at Disney. Disney's actual yield and actual payout ratio are lower than the expected numbers. So to the extent that I trust this regression and I focus just on dividends, my conclusion would be that Disney is paying out too little in dividends. You know what I'm missing in this regression? The fact that Disney is returning so much cash in the form of stock buybacks. Maybe this regression should be run in terms of cash return to stockholders, dividends plus buybacks. The problem with buyback regressions is buybacks tend to be lumpy. They tend to be big in some years, small in others. But if I can figure out a way to smooth that number out, maybe that's the regression we should be looking at rather than the actual dividends. So all of this is leading up to an end game here. We have an assessment of dividends for a company based upon by looking at the company's fundamentals or looking at the sector. And we might decide that based on the company's characteristics, that dividend policy that the company's picked is right for the company. But what if a company's characteristics change? What if it is going from low growth to high growth? I know that's unusual. The transition is usually the other way. What if you're going from an opportunity set where you have relatively few projects to one where there are lots of projects, and you really want to change dividends? After all, if the circumstances change, your dividend policy should change as well. But here's the problem you face. Remember we talked about the clientele effect? That you get the investors who like your dividend policy? So let's say you're a low growth, low risk firm that has acquired an investment clientele that likes high dividends, and you keep them happy by paying them high dividends. Let's assume now that the world has shifted under you. You've now become a high growth, high risk firm. You're saying that's not likely to happen? Let me give you an example. Remember the old phone companies? Prior to deregulation, these were regulated monopolies with stable and predictable earnings, which paid big dividends, had very few reinvestment needs, and could afford to pay those big dividends. They had investors who liked big dividends. Then in the mid-90s, as you had deregulation and technology enter the game, these telecom companies discovered that they were now riskier technology companies and that they could not afford to pay the dividends that they used to. Let's say that you're the CEO of this company and you're deciding what to do now. And here are your choices. The first is you can go in front of your stockholders and courageously announce that you're going to suspend their dividends. My suggestion to you is don't try this because you're not going to stay CEO for very long because these investors really like their dividends. The second is you can do the weak thing and continue to pay out dividends on the one hand, issue stock or borrow money in the other, and go out and make the investments you need to make. A lot of companies did do that. The third is you can cut back on the investments and hope that you can stagger your way through this growth business, but then you're going to be at a disadvantage relative to your competitors, right? There's a final choice that you might want to consider, and some telecom companies did do this. Your problem is, as an old telecom company, your investor base doesn't like dividends, right? You now have a segment of the business that's riskier, higher growth, and it can't afford to pay dividends. What if you spun off that business, made it a standalone company, and offered investors in your company the choice of whether they want to remain investors in the old phone company with big dividends or become investors in the new company with far lower dividends or maybe no dividends? If it works, I think this might be a solution that meets all your requirements. But what I'm trying to argue for here is sometimes when things change, you might have to change your dividend policy and you have to start thinking about ways in which you can transition to that better dividend policy. Overall, though, I think the way we pay dividends and set dividends reflects a bygone era. And here's what I mean by a bygone era. We tend to forget this, but corporate bonds predated equities as an investor choice. In fact, you started to see corporate bonds issued in the 1800s. Equities came into the market after corporate bonds, and to get people to buy stocks, here's what companies had to do. They had to make them look like bonds And the way they made them look like bonds is by offering large dividends. So the initial rationale for paying big dividends on stocks was to make them compete with bonds. So that's why companies got into this habit of paying big dividends. Equity, by its very nature, entitles you to a residual cash flow. You get whatever's left over. To me, it makes no sense to have a fixed dividend with a residual cash flow. What makes far more sense for me is a residual dividend. You can get there either by switching from dividends to stock buybacks, where you actually return the cash you have available, or if you don't want to go the stock buyback route, why not a policy of actually paying out what you have left over at the end of every year? Why not a policy of special dividends every year that really reflect what you can actually pay out that year? I think, in a sense, it's time we went back to basics on dividend policy. I know the tradition is that publicly traded companies are supposed to pay fixed dividends, but maybe we need to re-examine that basic proposition. Overall, though, we have to renegotiate our way through how to set dividend policy, because the way we're approaching dividends right now, we're approaching a point where many companies can't afford to continue to pay fixed dividends given how volatile their earnings have become. No wonder US companies have shifted to buybacks, and I expect other companies around the world to start following suit. Thank you very much for listening.